Welcome to Uncovering Trust, a podcast by Edison Group. I'm your host, Chloe Wong, and today I'm joined by Miloš Peps, Director of Investment Company Content at Edison, to talk about VinaCapital Vietnam Opportunity Fund, ticker VOF. Miloš, thanks for joining us.
Thanks, Chloe. Good to be here. VOF has just completed its financial year to the 30th of June, 2026. So we have a useful combination of fresh portfolio data and a very interesting backdrop for Vietnam's economy and capital markets.
Let's start with the basics. What is VOF and what is it trying to achieve?
VOF is a FTSE 250 constituent listed on the main market of the London Stock Exchange. It launched in September 2003. It's managed by VinaCapital with Can Vu as lead portfolio manager and is domiciled in Guernsey. Since inception, the fund has delivered an annualized NAV total return of around 11% in US dollars terms. Its objective is medium to long-term capital appreciation from investments across Vietnam's public and private markets. The portfolio is benchmark agnostic in construction, but VOF aims to outperform the FTSE Vietnam All-Share Index over the long term. The important point is that it applies private equity disciplines, not only to unlisted companies, but also to many listed investments.
What does that mean in practice, and why is it a differentiator?
Yes, so at the end of July, listed equities were at close to 80% of NAV, private equity 12.5%, and cash and other assets at close to 8%. But I would note that the distinction between listed and private does not tell the whole story. A significant part of the listed portfolio was originally sourced through privately negotiated transactions. For example, private placements or pre-IPO allocations, rather than simply bought in the market. That can give VOF access to entry prices or deal terms that ordinary secondary market investors cannot replicate. It also means that the manager thinks in multi-year terms and is prepared to negotiate meaningful stakes and protections where appropriate. That privately negotiated approach is an important part of the equity story. Although the recent difficulties in some legacy private real estate holdings are also a reminder that, liquidity can cut both ways.
Let's turn to the latest financial year. What were the headline performance numbers?
Yes, FY26 was described by the manager as a year of transformation. VOF's NAV total return was 9.5% in US dollar terms, while the share price total return was 11.9% in sterling. Financials, real estate, and industrials were the main positive contributors, while consumer, including the fund's IT exposure, detracted. The obvious comparison was with the VN index, which returned 36.5% in dollars, but that headline was unusually concentrated. Vingroup, the listed parent company, rose by more than 300% and contributed about 26.5 percentage points of the index return. And excluding Vingroup, the broader market returned around 10%. VOF did not hold Vingroup during the last financial year, but has invested for the past 8 years in a significant part of its ecosystem, that is Vinhomes, the country's largest real estate developer. So, the gap to the headline index looks much less dramatic once that concentration is recognized.
And what does the market look like underneath that headline?
I would say that valuations remained quite bifurcated. The VN index was on roughly 11.6 times forward earnings at the end of July, but below 10 times when we exclude outliers. These valuation levels seem, detached from the robust underlying corporate performance, with VinaCapital estimating a 22.3% earnings growth across the broader market this year, or around 16% excluding Vingroup. And valuations are actually closer to levels seen during market downturns. VOF's own portfolio was valued at about 8.6 times the 2026 earnings, with expected EPS growth of 23.5% at the end of July. That combination of value and earnings growth is one of the manager's main arguments for the opportunity today. VOF highlighted that many of its high conviction holdings were oversold in the recent July sell-off, and with an 8% cash level, it intends to add to several positions at attractive prices. Now, the macro picture is much stronger than current valuations might imply. Vietnam's GDP grew 8.2% year on year in the first half of the year, which is the strongest first half growth in more than 20 years, while listed company earnings grew by over 40% year over year in the first half, according to VinaCapital. I think it's worth noting, though, that market liquidity weakened materially during the year as foreign investors continued to sell, bringing foreign ownership to a historically low level of around 13.5%, which compares to 17 to 19% before 2025. And I would also note the higher local deposit rates, which drew retail money away from equities. And this is important because retail investors account for around 80 to 85% of daily trading volumes.
Has the investment team changed the portfolio significantly to capture that opportunity?
Yes, VinaCapital reorganized the investment team around 4 core areas, that is financials, real estate, consumers, and industrials, with each sector team covering both public and private opportunities. FY26 was also one of the most active years in VOF's history, as it transacted $843 million of investments, including $472 million of disposals and $371 million of new investments. As a result, portfolio turnover reached 39%, which compares with a historical single-digit average. The manager is very clear that this was a deliberate repositioning rather than a change in philosophy. And the aim was to move capital towards businesses with stronger earnings quality, better valuations, or more attractive structural growth drivers as Vietnam enters its next phase of development.
Can you give us some examples of what changed?
Yes, financials were the busiest area. VOF trimmed long-held positions in Asia Commercial Bank and VP Bank, and increased exposure to banks including MB Bank, Vietin Bank, BIDV, and Vietcom Bank, where the team sees stronger deposit franchises, lower funding costs, and attractive returns on equity. It also increased exposure to securities companies, which could benefit from higher trading activity and capital market issuance as Vietnam moves into emerging market indices. Several of those positions came through proprietary transactions, including private placements and pre-IPO investments. Industrials provides another good illustration. VOF exited Airports Corporation of Vietnam after a successful 10-year investment that generated an 18% dollar IRR. And that was because the manager was concerned that heavy capital expenditure on Long Thanh International Airport could depress returns for a period. It redeployed into Gemadept, the deep sea port operator, and into the pre-IPO of Galax Infrastructure, both of which are more directly linked to Vietnam's infrastructure build-out and supply chain integration.
What about the consumers and real estate, where the picture has been more mixed?
Yes, well, consumer demand was subdued for much of FY26 as households rebuilt savings depleted during the pandemic, and higher rates and energy costs weighed on spending. VOF increased its conviction in mobile world, which delivered strong earnings growth while continuing to reduce FPT Corporation after a very successful 9-year investment, because the manager believes AI is changing the competitive dynamics of IT services. The more recent macro data are a little more encouraging. Real retail sales growth accelerated to 7.3% in the first half, despite high petrol prices and interest rates, as well as normalization of tourist traffic. So the consumer recovery is not straightforward, but there are signs that domestic demand could become more resilient. In real estate, Vinhomes was the largest contributor to fund performance and rose 91% during FY26. VOF also trimmed Can Dien House and added to Nam Long Group, whose affordable housing focus fits the structural demand story. Just as importantly, there was progress on the legacy private investments affected by the 2022 property financing crisis. Daksang Services was restructured into listed Daksang Group shares. VOF received partial proceeds from a Novaland collateral asset after year-end, and the Hung Tin Land's exposure was restructured with stronger security and a clearer repayment path. The manager has said it will keep less liquid private exposure around current levels until it has demonstrated further recovery and returns from that part of the portfolio.
I understand that VinaCapital also provided an update on performance in July 2026, which was more challenging.
That's correct. VOF's NAV declined by 8.6% in US dollar terms in July, which VinaCapital highlighted was in line with the broader market sell-off, despite better than expected corporate earnings in Q2. Main detractors were Funyuan Jewelry, so P&J, whose share price declined by 51% due to market scrutiny following a police investigation at its wholly owned subsidiary, as well as Kangyan House and Mobile Words. VOF reduced its position in P&J by half to limit downside risk. This particular company made up 5.6% of VOF's end June NAV.
Taking a step back, what are the main reasons to remain constructive on Vietnam itself in the long run?
I would highlight three. First, the structural growth drivers are still powerful. Foreign direct investments, the relocation of manufacturing supply chains, a young workforce, rising incomes, and a major infrastructure program. High-tech exports, in particular computers and electronics, were especially strong in the first half of 2026, while infrastructure spending remains an important support to growth and stood at around 6% of GDP in the first half of the year. Second, Vietnam's capital market is approaching a major milestone, as FTSE Russell has confirmed that Vietnam will move from frontier to secondary emerging market status from the 21st of September 2026, with inclusion phased through 2027. Estimates differ, but around $2 billion of passive inflows is, I would say, a common estimate, while FTSE Russell has indicated that passive and active flows together could reach up to about $6 billion. I would say that the future MSCI upgrade would be a bigger step again, although it requires further reforms around market access, foreign ownership, and currency infrastructure. Third, there is the sovereign credit rating story. Vietnam is one notch below investment grade at S&P and Fitch and two notches below at Moody's. An eventual upgrade could lower the country's cost of capital and broaden the pool of international investors able to invest in Vietnamese debt and other assets. I would say that that is a less visible catalyst than the FTSE reclassification, but potentially an important one over the medium term.
Let's bring the discussion back to VOF's own valuation and shareholder returns.
Sure. At the 30th of June, VOF had net assets of $927 million, or around 700 million pounds, and its shares stood at a 20.6% discount to NAV. That was a wide discount and partly reflected the difficult backdrop for London-listed investment companies, as well as weak foreign demand for Vietnamese equities, as I've just discussed. The current discount to NAV stands at around 17 to 18%. Now, the board has been active on capital returns. VOF targets dividends of around 2% of NAV per year through two interim payments, and among the London-listed Vietnam funds, it is the only one paying a regular dividend. The last 12 months distributions amounted to 11 pence per share, equivalent to a yield of about 2.4% at the end of June. Buybacks have been the larger lever, as the fund repurchased more than $90 million of shares during the financial year 2026, which is equivalent to around 11% of shares outstanding. And I would note the total capital return through dividends and buybacks since 2011 reached almost $900 million.
The fee structure has changed as well, hasn't it?
Yes, and I think that is an important shareholder alignment point. From the 1st of July 2026, the management fee became tiered. So 1.2% on the first $500 million of net assets, 0.8% between the $500 million and $1.5 billion, and 0.5% above that. At the end June asset level, the long-term effective base fee is about 1%, which is roughly 30 basis points below the previous arrangement. Transitional arrangements are in place to help the manager move to the new fee structure. The performance fee is now based on rolling 5-year performance versus the FTSE Vietnam All-Share Index at 3 basis points of fee for every 1 percentage point of relative performance, with a clawback for underperformance, no carry forward of performance fees, and a lower total fee cap of 2.5% of net assets. The manager must also use 25% of any incentive fee to buy VOF's shares and hold them for at least 5 years. Overall, the new structure makes the benchmark more relevant and strengthens long-term alignment.
Before we wrap up, how would you summarize the investment case today?
I would put it in 3 parts. First, Vietnam still combines high economic growth with long-term structural drivers such as industrialization, infrastructure investment, rising domestic incomes, and growing participation in global supply chains. The FTSE Emerging Market Upgrades provides an additional capital markets catalyst. Second, VOF offers a differentiated way to access that story. It combines listed and private equity, and much of its deal sourcing comes through negotiated transactions that can offer better entry terms than the public market. The recent portfolio repositioning gives us useful evidence of how that model is being applied under Can Vu's leadership, while the manager is also addressing the legacy private real estate issues rather than ignoring them. And third, the underlying portfolio is on a relatively low earnings multiple with double-digit expected earnings growth, while the shares are still on a substantial discount. Add in buybacks, regular dividend, and the cheaper, more performance-aligned fee structure, and the valuation case is quite interesting. The main risks remain the usual emerging market ones, so higher interest rates, currency and geopolitical shocks, and the execution risk around private investments. But the long-term Vietnam opportunity remains compelling.
Miloš, thanks for your comprehensive overview.
My pleasure, Chloe.
You've been listening to Uncovering Trust, a podcast by Edison Group. To find out more about VOF and other investment companies we cover, please visit www.edisongroup.com.